Okay, perfect.
Snowballed. I mean, like that.
Let us know if you need anything else.
Hello. Okay, I think we're all here. Andrew, are you there also? Okay, I think we can just get started. Hey guys, welcome to our workshop on cryptocurrency trading. My name is Ian. I founded CoinRoutes along with Dave 4 years ago to help investors trade more effectively across exchanges. Right now, we're primarily an institutional product, as you can see from our website.
Hi, Andrew.
Hi.
Ian, are you going to share your website?
Yes.
Awesome.
So let me just share. Cool.
There it is.
Here we are. So this is our product. We are currently doing over $5 billion a month in transactions. Basically, we allow investors to trade more effectively across all of the exchanges. So people have accounts with different exchanges like Coinbase, Kraken, and Gemini, and we allow them to trade across all these different exchanges without having to, put all their assets on one exchange. So crypto markets are kind of a little bit different from traditional markets in that the exchanges actually are both acting as a matching engine. So they match buyers and sellers, and they're also doing custody, and they're also acting in some ways kind of as a broker. So this is a lot different from traditional markets where, if you want to trade, you typically go through a broker like an E-Trade, and then they actually go and execute on exchanges like, NYSE and NASDAQ, right? But it's not like a regular retail user can just go and open an account with the NYSE or with NASDAQ, right? You kind of go through these brokers. And so crypto has evolved a lot differently in that there is no need to go through this kind of what you would call, a broker. And so you actually go directly to the exchanges. And so people use us to provide algorithmic trading and whatnot that typically kind of your broker would provide in the traditional sense. But in crypto, it's kind of more decentralized in that you can just go and open an account with all of these exchanges directly. Yeah, I saw a question there. Do you guys provide liquidity? So we integrate with over 40 exchanges and liquidity providers. So I think like the biggest difference between like a liquidity provider and an exchange is in crypto, on an exchange like Coinbase, typically you have to pre-fund your assets. So if I want to buy, $1 million of Bitcoin, I have to have my $1 million in cash sitting on that exchange. And that's kind of different, especially in the US. A lot of crypto exchanges are not really providing margins. Some are, but most of the time you have to kind of have all your cash or all of your coins on the exchange in order to actually execute. Whereas a liquidity provider will extend you credit, right? So it's a little bit different in that respect. But our software doesn't really care whether it's a liquidity provider slash kind of over-the-counter trading desk or an exchange. We can route your orders across all of those different places. Cool. Ali, do you want to introduce yourself? You're muted. Kind of unmuted. On the lower.
There we go. Hi, everybody. My name is Allie. I've been with CoinRoutes for not that long, actually, for a couple months now. I've been in crypto since maybe 2016, 2017. I do a little bit of operations, a little bit of business development, and some sales. And I love being with CoinRoutes. It's so much fun. I love working in crypto. I never thought I would be working in crypto, and now I am, and it's fun.
Andrew, introduce yourself.
Hi, my name is Andrew Quinn.
I built the front end that you're seeing now on your screens. I've been with CoinRoutes for 2 years, and we are looking to build out a team to help redo this interface that you're seeing here.
Dave, do you want to introduce yourself?
Sure. So I'm Dave. I'm Ian's co-founder. I'm the designated old guy. I actually am a late convert to crypto, but maybe one of the most zealous ones. We started almost 5 years ago now. It's crazy how long it's been. And my career before crypto was all in automation of the equity markets and quantitative trading. And so we brought some of that kind of expertise to crypto, but to be blunt, crypto is very different. And I think all of us here, why we're so excited is we really think that crypto is the core of what will be the new financial system going forward. A lot of what, when you talk about Robinhood, who makes more money in crypto than they do in equities, they're probably not disagreeing. But when you think about, traditional firms and banks, et cetera, we think that many of those processes are going to change. And some of what we want to talk about today is the differences in the market, but it's important to keep our eyes on what's really happening. Bitcoin is a store of value globally, distributed finance to replace many of the legacy financial systems. Crypto is a way of payment and setting up social networks, et cetera, to be able to compensate people, whether it's in games or in art like NFTs, et cetera. So that's really the core here. And we're all very excited about the industry and about our part in it, which is to help people trade.
Right. And I saw an interesting news piece the other day, I forget where they were basically saying it's more likely that this exchange called FTX, I don't know if you guys have heard of them, but they're a $20 billion crypto exchange. And the news outlet was saying basically at this point, it might actually be more likely that FTX ends up buying NASDAQ other than the other way around. Whereas they actually just started 2 years ago and they're already processing, so much transaction volume globally. And they're just growing so fast. And I think one of the other big differences between kind of the crypto markets and traditional finance is it's a global market. So Bitcoin trades in the US, in Europe, in Japan, everywhere. The same exact instrument, completely fungible with each other, trades on exchanges all over the world. Where if you look at traditional finance, typically an equity like IBM has a listing exchange and it's trading in the US. And if you want to buy IBM in Japan, you have to buy it through what's called a GDR, an ADR, an American depository receipt, right? And so the better example is, if I want to buy Sony stock in the US, I end up paying a bank all of this, extra fees in between to trade it on a US exchange. Whereas in crypto, you can trade the exact same underlying instrument, regardless of what country you're in, without paying, all of these intermediary fees, right? And so we think that's a really powerful construct for kind of global finance. And we think it's definitely going to disrupt the traditional financial ecosystem. And it's already in a lot of ways kind of happening. That said, it's going to take a long time. Like, big banks aren't, just going to step over. And in a lot of ways, they're already realizing that, they have to get into crypto, and they are. So it's really interesting to see the way that this evolves. Now, FTX is not a competitor. We integrate with FTX. So a lot of our clients actually trade on FTX, and they use our algos, like our smart post algos, TWAP, which is time weighted average price, scheduled post, and then we have a stop loss order. That's kind of this pan exchange stop loss order. So we integrate with all of the exchanges that you mentioned.
Right. Okay.
So I post.
Do you want me to present and just go a little bit of the history stuff, Ian, or you'd rather do that later?
Yeah, we can start with the presentation, then we can open it up to questions if you want to do the presentation.
Yeah,
Cool.
cool.
Stop sharing.
If you guys want to post your questions in the Q&A section at the top instead of the chat, I think it would be a little easier to answer those questions. Although,
so yeah, before we go into the presentation, I'm just going to put a couple of orders out there. This is using our simulators. We built simulators for all the exchanges we support. So you can see Sim FTX. We have an FTX simulator. This is using their real market data. A lot of exchanges don't have great simulation environments, so we built our own. But what I'm going to do is I'm going to put out some orders out there to say, okay, if Bitcoin falls below 42,650, I'm going to sell 10 And you can kind of get an idea for how this works. So I'll put out a few orders and we can kind of come back to this later. Let's see. Okay, so with that, let's jump into our presentation. We'll stop sharing.
Let me try here. Let's just do it this way as I'm doing the whole screen. I don't know how well this is going to look. How does it look? Can everyone see this?
Yeah.
Okay, so this is basically us going backwards. This is to level set. For those of you that don't trade in equity or other markets, we just wanted to talk a little bit about the differences and how crypto is evolving. And I think it's important to understand that, like, we view ourselves, like the question about FTX is important. So FTX is an exchange, and they actually were incredibly innovative. They were the first one to allow what's called cross-product margining. That sounds like a crazy economics term, but what does it mean? It means if you deposit Bitcoin, you can trade every instrument on their platform without having to switch it into something else. Even if you're going to trade Luna, which is a coin versus versus dollars. So that was really easy. Everybody else made you have to change your Bitcoin into dollars before you would trade in one of those instruments. And so FTX got a huge leg up. But why I mention it is they refer business to us and vice versa, because what we are is a software company, and we help people trade based using algorithms, or you might call them bots, to be able to work your order without having to sit there and furiously type new prices and keep up with the market. But before you even talk about that, it's important to understand how the market works. And when we first got into crypto, and this was in 2017, we tried to explain the difference between the way the market was trading, which was basically all on, believe it or not, Skype, Telegram, and still people traded on the telephone. Hard to believe. And they would call somebody and say, okay, what's your price for buying Bitcoin? And they get a price and they trade. And basically what that would mean is you'd have multiple markets, each quoting the same price. And it's literally a lot like going to the Grand Bazaar. You buy a carpet and then you go down 3 stalls down and you might find that same carpet at a vastly different price. That's not really a great way to do market. So what we look at, and what we are called smart order routers, mean we help you find, or help our clients find, the best possible price for trading. Not necessarily to buy, but maybe where to place an order so that somebody else can hit their bid, or somebody else can lift their offer and trade. The way markets work, it is generally, the idea is to be able to find better prices. So why do we think this is not the best model, and what does matter? Well, you need investor confidence. Now, in crypto, that's happening, and it's happening pretty quickly. People worry about things like manipulation, though. So if you read the FT or the FT, Financial Times, the Wall Street Journal, Bloomberg's even worse, New York Times, God forbid. These people consistently talk about Bitcoin as a manipulated market, and it's not fair, and people being taken advantage of. In fact, the SEC has consistently said things like this too. Now, we, however, see a lot of this data, and we know the market is improving. And I'm going to show you some of what we've seen.
Hey,
but the reality is that's important.
Actually, so I think maybe it would be helpful. I don't know, how knowledgeable everyone here is on actually how exchanges work, but I wanted to just kind of go through a little quick thing on how kind of the markets work. So let me just show you. This is actually one of the.
Should I stop? Do you want me to stop sharing?
I think I can share also. But basically, so we talk about order books and placing prices and taking liquidity, and there's all these kind of really complicated terms, right? But what it really boils down to is, if you have an exchange, there are people who have placed orders to buy and to sell at certain prices. So if you look at this model here, basically, let me just zoom in a little bit. Imagine everyone, like, there's all these buyers and there's all these sellers, right? You can see right here. And how do we actually make this a real-time exchange? Well, what happens is you basically have all the buyers and all the sellers stand in line, right? So for the buyers, the person who's willing to pay the highest price is the first in line, right? And then for the seller, the person who's willing to sell at the lowest price is the first in line. And so what this actually means is, if I want to go, like, these people have to wait. They can't get their order filled immediately, right? Anyone standing in line, they're just waiting for someone to hit their bid or lift their offer, right? And so what happens is, when I actually go and put a market order out on these exchanges, I'm basically just walking this line of people or orders. And so, for instance, if there's if there's a buyer who wants to buy one Bitcoin at $89, if I'm a seller, I can immediately on the wire go and sell him one Bitcoin for $89. But if you notice, if I want to sell more than one Bitcoin, and we can imagine this person, this thing at $79 is there, my price gets lower and lower. And so that's what we call market impact, right? So if I want to buy one Bitcoin, the price to buy one Bitcoin is probably going to be cheaper than if I want to buy 1,000 Bitcoin. And so when we talk about routing and placing orders and all of this stuff, really what we're saying is we make it more efficient for you and people like us, make it more efficient for you to be able to place large orders and trade a lot, basically, because the basic principle is the larger the size of your order, the more you're going to hit the market, right? And so that's why all of these technologies exist, to try to break up orders and trade smarter and whatnot. So that's just a little bit of background on how this stuff kind of works. The other thing to keep in mind is generally on exchanges, if you want to place an order, or i.e. you're willing to wait in line, you pay a much lower fee than if you want it done immediately. So for instance, on Kraken, you might pay 0 fees to post, to go and wait in line, but you might pay 10 basis points or 0.1% in fees, even at the best fee tiers, to go and get it done immediately. And so that's one of the other things we do, is we figure out what price do I want to post this order at, how big do I want to make it, all of that sort of automation around it, that a machine is just going to be better at doing this than a human trader. Okay, I think you can go back to your presentation now.
Actually,
Okay, cool.
Ian, can I ask you a question?
Yeah, sure.
Can I just, if I show you like my window that I'm just looking at ETH on FTX, as somebody had asked about FTX. So when you say waiting in line, which side of the red and green is that?
Both.
Both, depending on if you're buying or selling. So I can give you, let me share this. Let me share the cost calculator so you can kind of see this a little bit also. So this is a tool we call the cost calculator. And what this basically does is it says, okay, if I want to buy a certain amount of coin or whatever, what would it actually cost me to do it? And what would the orders be that I would take in order to do this?
And does this include fees for the different exchanges?
Yeah, so there's this use fees box here, and it's customizable per fee. So you can see what the fees paid would be. So here, if I'm buying 100 Bitcoin, it's going to cost me, what is that, 4 million? Is that 4 million? Yeah, $4 million net, 4.26, whatever. And then that's the amount of fees that I would pay to the exchange, and that's inclusive of kind of like the taker fee. And you can see this is the amount that I would route to each exchange. So FTX and Kraken are roughly 50-50 split in terms of the amount that I would send to them. I would send 45 to FTX and Kraken, and then 9 to Coinbase, right? So if I want to get this order done right now, it's going to get broken up and routed to these exchanges. That said, you can do better than this by trading it algorithmically, which is kind of one of the things that we do, and going and waiting in line and kind of slowly piecing it out into the market. And that's kind of, our biggest advantage, and that's what our clients use us for, is for basically breaking these orders up, posting them at prices, figuring out kind of like a short-term price signal to be able to more effectively figure out how aggressive we want to be, stuff like that.
So this cost calculator that we're looking at, this is sort of the analog version of what the software actually does, correct?
Yeah, so right. So our most basic order type, which we call sweep, is basically doing exactly what you see here. It's just saying, okay, if I want to get this done on the wire right now, how much do I send to each exchange, and at what price? And that's okay, you can do that. But 80% of our order flow is not done this way, is done via what we call our smart post algo, which will actually go and piece it out slowly and post, to take advantage of not paying the taker fee and also capturing the spread. So not paying the far side price. You basically get halfway in between the spread.
Can you show us that?
Sure.
I want to see this in real time.
I've actually played some orders before.
Yeah.
Yeah, so what we can do is we can actually kind of compare this side by side. So right now, let's say I want to buy 10 Bitcoin, and this is against a simulator. First, I'll do one as a sweep, which is exactly what you saw before, just going in, or let's make it 100, which is just going out and hitting those exchanges. Let's do this. Right, so we have 3 exchanges. If I want to go sweep, I'll do that, and then right at the same time, I'm going to do the same thing with Smart Post, and I'll put in those 2 orders, and we'll kind of let this run.
And then what's all that on the screen? I don't remember if you went over this. So there's the, oops. Is this like your current holdings then? And these are all the coin pairs?
Let's put this up. So we can see that this order that I put in, this Smart Post order, is basically, you can see it's 14% done, 20% done, and it's kind of piecing it out slowly into the market. Whereas the sweep just kind of got done immediately.
So sweep is one sort of transaction.
Right.
Why don't you just do the routed orders tab, Ian? Just open them up so you can show them both.
Yeah.
So we can wait for this to go flush.
Oh, Dave, does Dave have it up? Dave, you're still sharing your screen.
Yeah, well, I can see, mine.
Dave, do you want to share?
Happy to.
Yeah, plus I think Dave's monitor is wider. It gives a better, cleaner view.
So if you do 100 Bitcoin. Right. So there are the orders that it's piecing out, whereas so you can see, are you seeing my screen now? Yeah. Okay. So everyone's seeing it. So you'll see it's putting out 0.628, 0.57, 0.74. Seems like a lot of work. It's only done 1% now on 100 Bitcoin, but it actually will move reasonably quickly to get itself done. Whereas if I did a sweep, you'll see it pretty much got everything done on Kraken and Coinbase almost immediately. Now, the difference is, of course, in a simulator, it just assumes it's going to take the liquidity. It doesn't actually reflect it in the price. But you'll notice that when this thing is all said and done, you'll see that the buying that we did on the simulator paid 42,000. It's hard to see. It's small, I realize. 42,717 to get done, and then of course also paid fees on top of that. Whereas if you look at how we're buying here, slowly but surely, it's 42,690 something or other. It may be more, it may be less. It'll depend on how the market moves. But what we can tell anybody, and our clients know this, is that over time, on average, the number for doing it this slow, steady way is significantly cheaper. Generally over 20 basis points cheaper for them, which is 0.2%. When you trade $5 billion a month like our clients do, that really, really adds up. And so that's a large part of what we do for people. So does that work, or do people understand exactly what that is? But you can kind of see it because, it's done 10% of the order, and it's already routed 7 different pages of orders.
So Dave, let me just ask you just some basic questions. So looking at these orders now, there's some that say canceled on the side, and what are those?
Right. So it tried to buy it at a price, and the market started moving higher, or it saw the market was about to start moving lower, which is what's happening now. And so it's smart, and it wants to buy at the best possible price. So if it sees that the market's moving lower, it will move out of the way and move lower. If it sees the market moving higher, it will get more aggressive to go higher. And that's a large part of what we do. When this is done, given what the market's doing, it's floating with the market. One of the things our clients care about is not impacting the market. So there's some game theory and some AI involved in what we're doing in terms of making those sorts of predictions. But that's why so many get canceled, and then they get filled when it says, okay, I'm going to stand here and let it get filled. And so
Because
it trades up, it trades down.
Sorry, if it kept posting and actually executing on every single one, like people looking, or certainly people using other software, they'd probably assume that it was some sort of aggregator, right?
No, you can't. It's really
market. What do you mean by that?
Well, so let's say, for the sake of argument, you want to buy 100 Bitcoin, and you type an order onto an exchange to say buy 100 Bitcoin. Most likely what would happen is you would buy nothing, and somebody would run in front of you and post at higher prices than you to move it higher.
Right. So it's kind of a game. Like, you can always post 1 penny higher, right? And so it's called being pennied. And so what you're really better off doing is not showing your full hand. It's kind of like a game of poker. Dave, you play poker, right?
Or it's like the price is right.
You're playing a few times, but yeah, I mean, like, you don't take your hand and just show it to everyone, right? You want to be able to kind of play with it a little bit, and so that's it's almost kind of like a poker game in a way, where you don't want to show your hand, right?
Right, but it's really important to understand that you have to. It's really hard to figure it out. You'll see the market is more or less now right back to where it was when we started.
So Richard just asked a question. So in traditional markets, you would call this basically an iceberg order, right? Like, you see an iceberg, in the sea, like, you only see this little thing, and you're like, oh, it's this little thing. But if you had radar or whatever, you looked under the sea, you'd see it's this huge thing. And so that's all of our order types are basically what we call a synthetic iceberg order, in that it's going to place, other than sweep, like, so all of our smart order types are going to place small amounts into the market, not show the hand. And the thing about using a software company like us versus a broker is that we don't have like an axe to grind. We're not trading for principal. And so if you go to a market maker or an exchange and you say, hey, I want to buy $1 million of this thing, in theory, they could run in front of you and basically start slowly buying and then sell it back to you at a higher price. And that's called front running. And so people like us, because we're not trading for principal, we're not, we don't have a reason to run in front of our clients. So, our model is an agency model. We just, we get a commission. And so we're not, going to go and run in front of our clients' orders, right? So they can put a large order in with us and we'll piece it out slowly.
Yeah. I mean, the point of all this is all electronic trading. And, people talk about, in the press about all this stuff. What's interesting is when we started in crypto, the world was all, I basically, if someone wanted to buy 100 Bitcoin, they would literally call or Skype 4 or 5 of these brokers and say, where could I buy 100 Bitcoin? Today, we still have an enormous, probably the majority of people still say, okay, show me a price for 100 Bitcoin and I'll hit a button. What we do is break it into pieces such that you're buying in this particular example, 100 Bitcoin significantly cheaper. That's really the biggest difference. And it's important because as more and more people start adopting methods like ours, and it's becoming pretty significant, the market itself improves. It breaks up orders into smaller pieces. You get significantly more turnover. You get significantly more volume. And that was sort of why we were going through the history lesson before, just to kind of describe what's gone on. But the markets as a whole, it doesn't matter whether we're talking about stocks, whether we're talking about bonds these days, foreign exchange, or crypto, it's all happening electronically. The difference is crypto is sort of late to the party and still has more manual pieces to it. Now, as a result, that's one of the reasons traders can make more money. There's also more volatility. There's a lot going on.
Yeah, so I see a question. Does breaking up orders like this decrease volatility, or does canceling of orders and reissuing them immediately increase volatility? And I think it's interesting because basically before, what people were doing is doing that sweep order where they're just going in there, wham, getting it all done. And that, like, a lot of times we see these really large candles and you'll see it goes way down and then way up. And basically what what happened was some, trader went and put in an order to buy 1,000 Bitcoin or whatever on the wire, knocked the price down, and then it immediately went back up. And so by using this kind of floating with the market algorithmic trading thing, it actually smooths things out and makes things less volatile and more efficient.
Right. So to answer that question, which, by the way, Ian gave a great explanation. That's exactly right. The answer is decrease. But it's really interesting when you go back a few years and you look at some of these things. So, we can make this presentation available to people. I just wanted to point out that in December of 17, when Bitcoin made its, quote, first all-time high, what you see, this blue line are the bids. And the orange lines are the offer. So at the first time that Bitcoin ever got to 19,000, you could have bought it for almost over $3,000 cheaper on a different exchange. But you notice just the size of these moves is like incredibly large and this big gap. And not a great look for markets. If you fast forward it just 3 months later, when companies like ours started coming in, you see the difference in the gaps so much smaller, still real, but the markets were getting better. If you go forward again to, another year later, 2019, you'll see this was an event where basically the market started falling and all of a sudden arbitrages fell out. But you see these really big moves. Even today, where are we? Even today, this was this year, May 19th. On May 19th, you can't even see the difference between the bids and the offers as it moved from 44,000, even down to 36,000. So huge moves. But what happened was, with this amazing 15% move, literally seven different exchanges had different types of outages. And so they were going down. And so markets got confused. And that's why you see these things opening up. But when the exchanges were operating, you can see that markets are much, much more efficient at keeping things together. And while we've had some excess volatility, and this volatility was huge, it's not caused by individual orders. And we could talk about what that volatility is caused by, but it's not the individual orders. And so, I hope that answers the question. But more and more people are doing things in order to keep these markets in line. That's kind of what we were trying to get at.
Yeah, I think it's like the key thing to remember is that if you want to trade on Coinbase, you need to have funds on Coinbase typically. So Eventually what happens is people just run out of funds on the exchanges. And then that's when you see these arbitrages kind of open up. And there are some networks that have been kind of created recently that alleviate some of this, but it's still definitely a problem because you need to have, in a lot of cases, funds on an exchange to trade there. There's no central clearing agency really. So, if there's a huge amount of volatility, sometimes you will see arbitrages open up between exchanges.
Right. But volatility is an interesting fixture of crypto. It's interesting, and we're going to get to it in a second, what some of the causes of volatility are because of some of the things that we care about. But just, here we are on a Saturday afternoon, and the market's moving. You'll see that the sweep traded at 47,717 and the smart post traded at 42,673. So it's pretty significant savings, when you look at it. And that's exactly the sort of savings that our clients tend to get on average. Now, we didn't script this. This could have gone the other way. This was live data. The reality is this is pretty close to normal. And that's kind of important. So if you want to understand what our value proposition is, that kind of encapsulates it, but that's only a small piece of the puzzle.
Cool. Any questions? Anyone want to come up? Ask a question? Keep going.
So when you're trading on an exchange, and you're just buying and selling, I mean, how else can you? There's no way to piece out these orders in the way that CoinRoutes does it, then, right?
No, it's a pretty much a simple thing. I mean, I spent most of my adult life, I think, replacing, traders who type on keyboards with machines that do the typing much faster. The reality is it's if you don't have an algorithm working for you, it's sort of like the analogy I always used to use for my Luddite friends was, would you fly in an airplane where the pilot announced that they weren't going to use avionics or autopilot during the flight? And the answer is you can do it. I mean, there are pilots who can sit there and use a joystick and fly a plane, but the truth of the matter is that we have modern technology for a reason, and we are modern technology, and that's why our clients are so happy with what we provide for them. And it's penetrating the market even more is certainly what we're up to.
Yeah, and then I mean there are some exchanges that kind of offer sort of a little bit of intelligence, but the problem is it's only looking at the prices within their own exchange. And if you're only looking at one exchange, you don't at all get an idea of the market, right? You might only be looking at 10% of the market, even on a large exchange. And so it's really important to see where all of the other exchanges are in relation to each other. Even if you're only trading on a single exchange, you still need to know, what the prices are on other exchanges, because what happens is the exchanges tend to mean revert around each other. So we have some clients only trade on one or two exchanges, yet they still get a huge amount of value out of using this because, the algorithm knows, okay, hey, this exchange is here, the exchange I'm trading on is here, it's probably going to come back. So we should be patient, or, this I'm buying and Coinbase is below FTX, I should, be more aggressive on Coinbase because we think it's going to, meet in the middle somewhere. So that's definitely, an element to it, is being aware of, where the entire market is.
Right. And you can see this graphically or visibly here by these are the top of where the exchanges are. And you might notice always literally almost always, the bids are higher than the offers. When you take fees into account, that's not necessarily the case, but you'll see that these exchanges move around a lot. And if you watch closely, you'll see how that happens. I mean, sometimes market makers are in there, but they move around, they change places, they kind of chase around each other. So that's
if someone wants to come up and join us. Did that work? No, they just Hello.
Hey, am I here? Can you guys hear me?
Yeah.
Sure. Okay, awesome. Sorry to interrupt. Yeah, I had a quick question I wanted to run by you. So I'm unsure of this when it comes to cryptocurrency. Like, are your investors interested in buying options or derivatives with cryptocurrency? Does the platform support that? What's the future when it comes to derivatives trading?
So I think our futures volume is almost bigger than our spot volume now, isn't it? Right? We trade.
Yeah, the derivative volumes are actually larger. That's actually the screen that I'm showing right now. CoinRoutes doesn't have options yet, but we do. A large part of our volume are in the perpetual swap and futures. Let me explain. One of the innovations in the crypto market, it's actually an incredibly smart innovation. We're certainly not taking credit for this. This actually started with a company called BitMEX. But they came up with this idea of a product called a perpetual swap, which sounds very complicated. But what does it mean? It means that you can buy or sell the price action of a crypto and have it every 8 hours or so, it gets funded and it continues to perpetually move. So rather than having to actually buy Bitcoin and get it into your wallet, you can just buy this derivative and get exposure to it. And a lot of these markets got very famous for allowing up to 120 times leverage, which is an insane amount if you ask me.
Maybe we should take a step back and kind of explain. So a futures contract is a contract to buy or sell a specific underlying instrument at a specific date in the future. And so typically, like the most liquid futures are recorded. There's a lot of feedback. Andrew, you want to mute yourself?
Sorry, I'm put on headphones. I think that's me.
And so typically what happens is you say, okay, I want to buy, a Bitcoin futures contract at this date in the future. And what happens is there's basically a difference between the futures contract and the underlying asset, and that's called the basis, right? And so what ends up happening is as it gets closer and closer to the expiration date, the basis shrinks, right? What a perpetual future does, rather than having to actually expire and settle at the end of the contract, is every 8 hours, there's a funding payment between the longs and the shorts based on if there's more longs or shorts, basically, essentially. And so it's this real-time thing that never actually expires. And so that's kind of one of the innovations of the crypto markets, and that's where a lot of the volume is on these perpetual futures.
Right, and in Bitcoin the volume is larger in these futures and swap markets than it is in the spot market, in large part because of leverage that's offered to investors. People can basically take $1,000 and say, okay, believe it or not, they could actually do take $1,000 and buy $100,000 worth of Bitcoin exposure. And if they get it right and it goes straight up, they can make an enormous amount of money.
Right.
Unfortunately, most people who take leverage that at that extreme amount, doesn't take much. They can get wiped out.
Yeah.
And so there's a lot of that sort of dart throwing going on in the market. So when you hear, and if you read in the press, people talk about, during that May 19th day, for example, you probably heard, or maybe you read about, there was literally $5 billion worth of longs liquidated. That's what they're talking about. They're talking about people whose leverage positions caused them to get evaporated. Boom.
Right.
Now, right. And when he was talking about the basis, so if you look here on our screen, we're tracking it in real time. Here, let me just change this so that it's easier to see. So like right now, the best offer is 42,580, but the spot price for Bitcoin is 42,614. So actually the derivative markets, and this has been true for like 11 or 12 weeks now, the derivative markets have been slightly lower, meaning there's more short speculators than there are long speculators. And it's been that way for a while now. That's why a lot of us think that, regardless of everything else, that the market, the bias to the market when there's news or when it starts moving is likely higher than lower because of that, because it's just contrarianness. And we could talk about price prediction as much as we want, but it's really important if you're trading to be looking at all of these markets. And that's something that...
And I just want to talk a little bit, like the information that you get in crypto is vastly more transparent than what you would get in traditional assets and traditional futures. Like right now I can see, okay, what's the open interest? What's the volume? All of these kind of data points that the average person couldn't get, in traditional finance. So all this information is kind of out in the open, and it creates kind of this different, market kind of ecosystem because everyone actually has access to this information. So if anything, it's more transparent. And I could definitely foresee a future where a lot of, right now, because of regulation, you can't have a perpetual swap on a US exchange. Like it's not allowed, so you have to have these futures that expire. But, in a lot of ways, the perpetual swap is a much better instrument than having to, every quarter roll your futures positions over, okay, so, my future is expiring. I have to sell that and buy another month out. It's like this huge pain, and it really just kind of means that the legacy market participants have a leg up. But, I foresee a world where, these perpetual swap instruments actually become, popular onshore. Whereas right now you can't do them in the US. Like you have to be outside of the US to do them. They're not allowed.
To put it in perspective, Sam Bankman-Fried, who runs FTX, he's not sponsoring basketball stadiums, putting his patch on umpires' arms. If anyone who's watched a baseball game has seen it. His idea is to have this go mainstream, and so he's spending a lot of that. Ian made the point that they'd raised money at an $18 billion valuation. They're spending their money to try to actually do this and improve the financial markets. And I would welcome anyone to listen. He's done a bunch of podcasts over the last several months where he talks about this.
Very interesting. Thanks for elaborating on that.
No problem. Right. So when you mentioned derivatives, Ian basically already talked about it. You can see that we show our clients different information. When you're looking at spot, you don't see this because it doesn't exist. But in derivatives, you get to see the full volumes, open interest. You can see how the bids and the offers are, and then there's other things, liquidation prices and other sort of things, which when you go to spot, there's less information. And that just happens to be the way that the products work. But from a CoinRoutes point of view, we care a lot about the more data there is to analyze, the better we think we do and the better our clients do. And our work ahead of us is that there's even more. And so it's analyzing it and making it so that our clients don't have to do a lot of the work, and that our algorithms can do most of the work using that data.
Sure. I mean, it makes perfect sense. Like as an investor, if you're worried about volatility, to rely on an algorithm that'll trim your position when the timing's right, and buy more when the opportunity's there, and then you can expect just a more even return over time. So, and you're not daily manually making trades yourself.
Yeah,
so it's appealing.
It is very. It's exactly right. I mean, it's different people do different things. I mean, I used to work for a quant hedge fund called 2 Sigma, and virtually every trade they did was done by algorithm. That said, in the crypto world, there are some very, very good market timers and traders who have systems. One of the other things that's interesting about crypto, and Ian mentioned the word transparency, which is a great word because it really applies, is we haven't talked about it, but at the end of the day, it's all based on this technology called blockchain. Well, I mean, I am not a blockchain, not Bitcoin or any of that stuff, but what it means is there's lots and lots of on-chain data. It's not what CoinRoutes does, but investors get to look at it and see all sorts of information about who or how long positions have been there, how flows are moving, every transaction that happens either to exchanges or from exchanges,
right,
not on.
So like Bitcoin is being transferred onto Coinbase, for instance, typically the intent of that is to go and sell it. And so that's like an interesting indicator that people use. So there's a lot more transparency, in blockchain than there is, in the traditional financial, ecosystem. Like you can't just go and see who wires money to who, right? You're not the Fed. So it's definitely more interesting. There's definitely a lot more data available, and it's harder to hide stuff like what's actually going on. So it's definitely a more transparent ecosystem.
Yeah, it's off topic, but for those who read about it and worry about Bitcoin being used for criminals, I once watched a talk and then talked to after him one of the department heads at the FBI, and he was funny about it. He said that they like the fact that people keep saying how great Bitcoin is for criminals because they loved it. The FBI would far prefer criminals to use Bitcoin than cash because it's way easier for them to trace. And you probably know there's been some pretty high profile, child pornography and other sort of rings that they've actually caught because they were dumb enough to use Bitcoin. So yeah, there's a lot more transparency in blockchain oriented payments.
Sure, and I have one more question for you. Sorry to interrupt. One more question for you, if you don't mind. So if your value proposition is that you're spreading these trades out across across different markets, essentially, so that you're lowering the cost of your clients who are trading through your platform. Are you affected? What's your insight into the Lightning Network or these other layer 2 protocols that are coming on top of the coins that are essentially, I think they're intended to kind of alleviate some of the bottlenecks that drive the price up when there's lots of orders in a short period of time that can't be fulfilled?
Yeah, I mean, I think it's actually good for us because, right now, if you want to be able to quickly transfer funds between exchanges, you need to be kind of a large institution. And there are networks, kind of private type networks called, one is called Fireblocks, which basically says, okay, rather than having to wait for 15 minutes confirm on the Bitcoin network, Coinbase will honor, I don't know if they actually do it, but whatever, Kraken will honor a transfer from Gemini with what they call zero confirm because it's been done via Fireblocks. And so what I think things like the Lightning Network do is it opens up that same technology to retail investors. And, one of the things that, is on our roadmap is actually going down and targeting these retail investors. And so, if retail investors can be armed with the same kind of funding mechanisms that these large institutions enjoy now, I think it's good for the whole ecosystem. And, we're happy for that technology to exist and to be, more used.
Yeah, I think that's a really, really strong point. It's also really worth understanding that, actually less than 30% of our volume is in Bitcoin from CoinRoutes perspective. And there's a lot of other crypto assets, particularly ones either like Solana and Ethereum that are people are associated with NFTs these days. There's lots of other marketplaces, whether it's supporting online gaming or whether it's supporting other potential level 2s or level 1s. We don't care. All of these assets need to trade. And there are people out there who want to either invest in those assets or they have acquired them and they need to sell them, etc. So it's a robust ecosystem. So the more the ecosystem develops, the better off we are, as a firm for sure. And the better people can transfer those assets, as Ian said, the better off our clients are.
Yeah.
Awesome. Thanks for sharing.
Yeah, no problem. Someone said something about latency. So it's really interesting because because of the fact that the same instrument is traded in, Hong Kong and Europe and America, and it's the same exact asset, you're actually better off kind of being a little bit smarter about how you're aggregating and the data that you use versus just being fast. If you wanted to get something done right, on the wire, kind of using that sweep order type, then speed, does matter because you need to hit it all at the same time. But if you're doing, what 80% of our volume is, which is posting and piecing out little orders at, good prices on these different exchanges, you're actually better off like waiting a little bit and waiting for the prices to come back to you. So, I mean, it's a little bit different from, traditional finance in that way. In equities in the US, all the data centers are in, northern New Jersey, like 40 miles away from each other, right? And they're connected via high speed, lines that are like not going over the internet. Like in crypto, even really large, multi-billion-dollar companies actually have to go over the internet and deal with public internet latency to all of these exchanges. So, it's not really a speed game. It's more about, being smart. That said, like if what you're doing is, purely arbitrage, then speed does matter. But, our clients are kind of being smart in, how they're trading the basis between all these instruments and, piecing it out in optimal sizes at the right prices. And so you're kind of better off being, smart than necessarily being the fastest in a lot of ways.
Ian, somebody just asked, Alex asked about resources for just sort of getting started in crypto trading. And I know that there's a ton of like sort of, Investopedia, Yahoo Finance, stuff like that. But is there anything, I mean, you've been in crypto for a very long time, so I'm not even sure if you know the answer, but where would you send people to sort of get started?
Yeah, I mean, I wrote a little bit from a doc earlier about like how an order book works, and it was actually written for equities, but I think it's a really good overview, and I'll post a link in here. It's a really good overview of like how order books work and all that sort of stuff works. But I think the really great thing about crypto is that, anyone can go and sign up for an account at these places. Like it's not like traditional finance where, I have an interactive broker's account, which is like kind of a reasonably sophisticated brokerage for, sophisticated retail investors. And I still don't really have access to all the real-time market data at the exchanges. It's still kind of slimmed down and aggregated and whatnot. But in crypto, you can actually just log on to these exchanges websites. It's publicly available. All the market data is publicly available. And so, it's all out there, and you can kind of go and look at charts and, do all that stuff. I like, coinmarketcap.com is a good kind of starter point to go and see where all the coins are and, kind of basic prices. And then, from there, you can kind of branch out. And, Dave, maybe you have a comment on this.
Yeah, I think, look, there are a lot of good sources. I mean, believe it or not, there's a lot of crap on it, but crypto Twitter is pretty good. There are a bunch of people I would follow. Jeff Dorman, who is the analyst from one of our clients, Arca. They do a weekly piece called Not My Two, or Our Two Satoshis, which is excellent. Always talking about the different fundamental drivers going on in the crypto sphere, other assets other than Bitcoin. Of course, another one of my personal favorites goes by 2-Bit Idiot. His name's Ryan Selkis. He runs a company called Masari. Masari is a more modern version of CoinMarketCap, and they have a ton of data. On-chain, Glassnode is probably the best, but Glassnode Studio, and they have both free as well as subscription packages where you can start to see some of that on-chain stuff. But as you branch out and start following, I think it's probably easier to learn. And Twitter's a bit of a pain because there's so much garbage on it too. But there's also some really insightful posts and threads, and inevitably you'll get linked to various research pieces that people will talk about. Another one of my personal favorites is Nick Carter from Coinmetrics. Nick is probably the best, certainly the most concise and well thought out about disabusing people of the Bitcoin energy myths, and talks about a large part about the market. And then you have, a variety of others. But, I think that's generally a pretty good start. And as Ian said, one of the benefits of crypto is there is much more public data than there is in equities. I mean, in other markets, and I used to run one of the larger high frequency trading firms, a company called 2 Sigma Securities. Trust me, I got asked all the time by professors and academics to say, okay, where can I get good data to research stuff? And my answer would generally be, I'm not sure that we can really help you here. And it was harder to get at that. It's a much bigger difference. In crypto, all that data is public, and different people have different ways of getting at it. Could I please answer this?
I don't
question,
know.
Ian?
HR department might have to get involved, so be careful.
No, it's not an HR thing. Look, it is really simple. Anyone who follows me on Twitter will know that, and follows Ryan on Twitter will know that I think most hardcore people in our industry are all about financial freedom. And Bitcoin represents financial freedom. You can, it was the original white paper. If you haven't read it, you should read it. It's 8 pages. It's pretty easy to read, and it's pretty clear. The idea of being able to transact peer-to-peer and person-to-person, just like cash, allows you the ability to have freedom with who you interact with. If you're a government that wants to control where your people trade, where your people buy, where your people sell, stop people from buying or selling from those who you don't want them to buy or sell from, or in fact charge them for the right to hold money as in negative interest rates because it fits their agenda, then you don't want Bitcoin. You don't want crypto. You don't want that financial freedom. So it should surprise no one that an authoritarian government is cracking down on it as they're looking to introduce their own digital currency, basically giving the government, as in this particular case, the People's Bank of People's, the CCP, the ability to control it. So it should surprise nobody. It's also interesting that China has banned crypto. Ever since 2013, I've seen counts for press releases and laws north of 200 times. It's actually been illegal in China for over 8 years, not to hold, but to use it transactionally. They just simply, every once in a while come out with more and more enforcement about it. And yes, it's probably serious for, if you're a Chinese citizen and you're a Chinese company, but that is really important to understand. We believe crypto is about financial freedom, which is why, weirdly, you're seeing politicians you never would have expected in the United States to talk about it as being important for American innovation. I'll leave that to people without getting into politics, which ones are that way and which ones aren't. But it's not a partisan issue particularly. It's an anti-authoritarian issue.
So we don't have to worry about that here, right?
Simon asked a question that I will answer. The answer is 100% yes. Now, technical analysis is something where you're trying to understand what's going on in the marketplace. Whether or not people are breaking up orders or not, it still shows up in the tape. The difference is when CoinRoutes is a majority of the volume trading on those exchanges, it will be slightly less meaningful than it is today. It will be less meaningful. But today, we're a minority. Our clients were going to trade over 6 billion this month, maybe 7. I think the exchanges are trading hundreds of billions of dollars. So it's a relatively small percentage that's being broken up this way. There's still plenty of dumb traders for you to see on the tape and take advantage of. Does that answer your question, Simon? Just a thumbs up or thumbs down. But I mean, that the bottom line is every single signal that's ever existed, and I ran StatArb for a bunch of years, that's statistical arbitrage, is basically when one person uses that signal, it works. By the second, third, fourth, by the time it gets to too many people using it, it gets less and less valuable. So for now, the fact that we're doing what we're doing, our customers benefit disproportionately compared to others. Eventually, we have to keep innovating and we have to keep pushing. But, right now, crypto offers so much more ability, so much more inefficiency than other markets that it's a very exciting. It's one of the reasons that so many traders are flocking to it.
I think we're just about out of time. Ian, are we? Oh, we're not. Okay, we can go till what, 5 it says?
When are we? I think. Is it an hour? How long is it?
It says time left 23 hours.
No, I think we're supposed to be done. I don't know.
Yeah, I think we need to.
By the way, if you guys haven't seen our coding challenge, have you guys seen our coding challenge? We're giving out 2 ETH in prizes total.
What's the link, Ann?
Yeah,
we should drop it in the chat.
If you want to join the Coin-Routes Discord channel, we are putting lots of information in there. I'm actually uploading some more sample code as we speak. I don't know if Ali's in the Discord. I'll just pop the link to the doc in here though. Let me do that real quick. So we're excited to see what you guys come up with. Let me find it.
And
there's a question out there which I'll give a quick answer to. The answer is it depends, Noah. He asked about FedCoin. If the FedCoin is replacing dollars to be more efficient in the marketplace without the kind of stringent, who you can use it for, etc. stuff of that they could program into it, then it's a major help for Bitcoin because essentially it just gets more and more people used to being digital. If, on the other hand, the goal is to control the financial market by the United States government at the expense of the people, then it's in direct opposition to Bitcoin. And being Americans, I strongly suspect that that's not going to be very popular, but I guess we'll see how it plays out.
I mean, like, just to be clear, so right now, a large amount of Bitcoin trading volume is done in what we call stable coins, i.e. some coins that are backed by dollars or, other assets that are trading on the blockchain. So you can see the biggest one right now is called Tether, USDT. It has a $68 billion market cap. Right now, a lot of traders, when they want to get out of Bitcoin, rather than trying to sell back into actual dollars on an exchange, will just sell into Tether. And so this essentially functions as kind of an on and off ramp for crypto when people want to hedge risk and do whatever. So if FedCoin comes out and is able to be fungible and is able to be a more kind of reliable stable coin, then if anything, it'll just help the Bitcoin ecosystem. And if it's not, then I don't really see it as an issue because, ultimately no coin that the Fed comes out with is going to compete with Bitcoin. It's still going to be a dollar. And dollars and Bitcoin are kind of, two almost opposite ends of the spectrum, right? Bitcoin's deflationary, dollars very inflationary. Really not deflationary. So I mean, yeah, it's like I don't see it, especially being an American, living in America, having an American company, I don't see it, as an issue. If anything, it'll just kind of help bring forward, the proliferation of digital currencies.
what was the other? Oh, what was the link in for the 2E thing? Was that the doc that you posted?
Yeah, that's the doc for our project. If you guys want to join the CoinRoutes channel on Discord, I believe you guys can join and we have some stuff in there about that. Just trying to upload. Does anyone else have any other questions for us?
And then what's the Discord, please? May we post that link or?
Yeah, I'll just post my Discord. You can just message me if you need to be added. This is my Discord. Is that?
And there's a link on our website, but yeah, good luck everybody on your hackathon.
Yeah, also we're hiring, so hit us up.
Yeah. We have a beautiful new office that we just.
Ali, do you want to show the video of the office?
Should I show it?
Show it.
Yeah, it's going to be nice when we furnish it, but yeah, we start next week. Next week or 2 weeks.
2 weeks still, but very excited.
Yeah. That's right. Thank you, Richard.
There's too many videos.
Yeah, don't worry about it.
Okay, well, whatever. It's beautiful. It's all glass. You can see the water.
Yeah.
All right. Well, thanks so much, everyone.
Thanks.
a lot.
Enjoy the rest of your weekend.
Guys.
Good luck. Bye-bye.
Bye-bye.